Welcome everybody, I'm Fraser Thorne, CEO of Edison, and I'm delighted to welcome you all here to Edison's 2026 Growth Conference. First off, a big thank you to all our team who've organised this. These things don't just happen, they take months of preparation, and they've done an immaculate job as ever, so that's fantastic to see. Secondly, a big thank you to everybody who's on a panel, presenting, and the corporates are here for the one-to-ones. And then lastly, a big thank you to all of you for turning up, all investors and partners, to come and make the whole day work. So we've got a very, very full schedule, and we will be quite tight on timing, so I will rattle through what I've got to say. We've got a lot of insights that we're going to be talking about on the panels today. Last year, AI featured very heavily, and not surprisingly, it does again today, with the panels all sort of talking about how it impacts their respective industries. So I will just sort of talk to a couple of slides just to say hello and introduce everything. So I think it's quite useful, investing is all about the future, but I think it's quite useful to look backwards sometimes just to understand as to how we got to where we are today. So this is the Fortune 500 top 10 companies by market cap in 2000. Now for those of you who are a bit wiser, older, more experienced, you'll recognize probably all of those names. For some of the others, there are some names there that you won't necessarily recognise. GE, for example, has now split itself into 3 different companies. But I think why I put this up is just to kind of like then look at where we are today. And what I think is really, really interesting with this is there's a couple of takeaways. One, the volume of value creation is staggering. It's quite incredible when you go back and to see what the market caps were of the largest 25 years ago as to what they are now. Secondly, it's the speed. The speed of growth of these companies has been absolutely eye-watering. Now, there's a couple of companies here. I mean, I have to admit, I am older than Microsoft. I'm older than Apple. In fact, most of this audience, bar a couple of our grads, are older than Meta and Tesla. Meta was founded in 2004. Isn't that incredible? In such a short space of time, it is now one of the world's top 10 largest companies. Now, the other thing that I think is very important is that I could give you some names here, and I know that you'll be able to put them to which company. Jensen Huang, Larry Page, Sergey Brin, Steve Jobs, Tim Cook, Bill Gates, Mark Zuckerberg, Elon Musk, and Warren Buffett and Charlie Munger. Now, the reason that I raise them is that what makes these companies great, yes, they're in the right industry, but as you would see in the previous page, Nokia was in the top 10. It doesn't even feature anymore. You know, what made Apple such a great business was and is the fact that it is driven by really high quality people. So what I want you to take away from today is that there is an opportunity in a world of tracking funds, in the world of passive money, in the world of reasons to not actually sort of get, running screens, quant funds. Actually, what makes a difference is people. So we have a fantastic lineup of panels, and I want you to please do ask questions, please do spend some time get to meet the companies that are here presenting, because they're the ones that are going to be the opportunities for today, for the future growth. With that, I'm going to be handing over to Toby Clothier, who's a Senior Fund Director of Oberon Investments, and then shortly afterwards, as the second keynote speaker, is Neil Shah, Head of Technology for Primary Markets at the London Stock Exchange. For those of you in the know, we are very, very lucky that, in fact, we have two Neil Shahs here today, as is often the case, is that our own Neil Shah, market strategist, and Neil Shah from London Stock Exchange, we often sort of receiving each other's mail in the post, and that's something that we always have a little laugh about. So we're delighted that we've got them. We've got double the Neil Shahs here today. So listen, I'm going to step aside, let Toby give you some thoughts on the market, on investing, on his experience in the investment world. Big thank you to everybody who's for making the time to turn up today, and please enjoy yourselves and have a very good conference. Thank you.
Morning, everyone. Thanks very much for coming. I'm Toby Clothier. I run a global thematic fund at Oberon Investments. Oberon and Edison are quite good friends, hence they invited me here to talk about a few things that have gone on this year, markets, how we see things, what's going on, and possibly some thoughts about what might go on in the future. I'm specifically not here to talk about our fund or about myself, but obviously if I don't tell you something about my background, then you'll be thinking, why am I listening to this guy, what does he know, etc. So just a quick potted history. My first job in the city was about 200 yards from here, working for a company called Chase Manhattan, which no longer exists. I was 19 years old, and I somehow ended up in the economics department of the FX division, and they gave me a project for 3 months, which was, please discuss the likelihood and implications of monetary union, and secondly, its impact on FX trading for our business. So I spent 3 months looking at that topic. The conclusion was, it's going to happen, and it's going to be a disaster for your business. So that obviously went down very well, and I potted off back to university. 3 or 4 years later, undeterred by that experience, I went to all the road shows, as you do when you're at university, and I met a very nice chap from Goldman Sachs, which nobody had heard of at the time, which shows you how things have moved on. And he said, you could do equity sales. That's basically broking stocks to institutions. We'll stick you in the European division because you speak lots of languages, so that'll be useful. So I ended up doing European equity sales because I spoke French and Spanish and a few other things. And so it began. So I'm not going to go through the next 32 years, but if I had to put a title on it, it would be Tales of the Unexpected. Some of my friends from Goldman, two in fact, are still there and about to retire in the next couple of weeks, which is quite surreal for me because I'm still working. But also, they have had a very different journey from me. I've ended up having quite an extraordinary period of highs and lows, including at least 4 booms and busts, which I was accidentally right in the middle of, including broking various things for 20 years, including being a risk arb analyst. Went to Mongolia 5 times, of which 4 were on business. Ran 2 hedge funds, both of which closed because the backers basically never showed up. Worked for 2 companies that went bust, 3 that got acquired, 5 that I resigned from because I got headhunted to go somewhere else. So I've been around, done a lot of things, had a lot of adventures, and hopefully since the days of rocking up at Chase Manhattan's economics department, knowing nothing, I may have learned a few things. I also did a master's in finance in the evenings when I was working at Goldman, which was an exercise in masochism. But anyway, let's move on. Enough about me. I want to talk about this year in markets, what's happened, and what is potentially going to happen next. What do I know? But we'll talk about that in a minute. I started off with some themes that I thought were interesting, things that were going on in January and February this year. Obviously, this year's been a game of two halves so far. But if we think about some of these things, what was happening as we went into 2026? First of all, inflation was generally moderating and I would say quiescent. We had moderate wage growth globally. Consumers were behaving reasonably normally after 2 or 3 years of not so much, given interest rates. Oil was at 60, least popular commodity globally as we came into 2026, which is quite surreal now when you think about what's happened. Bond yields were falling globally. Lots of people were expecting interest rate cuts, including us. We thought there'd be at least 3 cuts in the UK this year, for example. An AI capex boom in the background, which we all know about, which we'll come on to more in a bit. Places like Japan, Brazil, and other emerging markets doing well. AI picks and shovels, which I'm sure will be discussed later, generally doing well as a result of the AI capex boom. The Mag 7 actually underperforming and being quite weak. That had been going on for 6 months or so before we came into this year. A massive developed markets government debt bubble that hasn't gone away, isn't going away anytime soon. And actually generally weak job openings globally, which is a function of various things, some of them structural, some of them potentially cyclical. So that was January and February. If you're an investor, it was fairly straightforward. You wanted to be involved in emerging markets, places like Japan and Brazil. You wanted to be involved in all things to do with AI picks and shovels, and things which were somewhat pro-cyclical because rates and inflation were completely under control. So that was then. Our fund, by the way, did quite well in that period. And then along comes a war. All change. Some of the things on the previous slide you will see are still here. Most changed. So the AI picks and shovels kept on outperforming. We still have moderate wage growth. But more or less everything else, there's still a big M&A backlog globally. More or less everything else has changed. And the main thing that's changed is expectations around inflation. Oil, as mentioned, least popular commodity, has gone from anywhere from $90 to $120 a day, depending on the day. That has led to a change in inflation expectations. Whether it's a good idea to actually raise rates, given what's going on in the world, is a whole different philosophical question. We think not. But anyway, be that as it may, people decided in March and April that inflation was going to get out of control, that there were therefore going to be rate hikes, so the idea of rate cuts went out the window. Emerging markets and commodities, obviously super sensitive to all that, did spectacularly badly. Anywhere energy dependent, Japan on the bottom right imports 90% of its energy, so Japan kind of collapsed briefly. The dollar, which everyone had been selling because they're busy buying emerging markets, recovered. So we essentially had a flight back into the dollar, safety, tech. And in particular here, the AI capex boom, or at least the second derivative effects of it, have gone into overdrive. The capex itself hasn't really changed. It's actually, the estimates have gone up maybe 10% year to date. But all things that feed off of that have become a extraordinary frenzy, which we can talk about in a minute. And in the background, there's a new meme stock craze, which reminds us quite a lot of 2021, which didn't end up well. Government debt bubble is still there. That hasn't changed. On the right-hand side, Turkey sold a bunch of gold, which had done very well to defend their currency, and people therefore started panicking about gold. So gold did not do what it was supposed to do, which is behave well in a war. In fact, it behaved quite badly for a few weeks, which caused some volatility and panic selling and various other things. So that was March and April. So far, all history, not very interesting. Where do we end up? Here are the numbers. Bond yields year to date are up in most places. I've just put a selection of different geographies on there. You can probably add a few more onto the UK number, depending on what happens in the next few hours. Commodities, copper's up 8% year to date, gold's up 10, WTI's up 61, Brent's up 64. And of the main indices, you can see there's a spread of a fairly lackluster 4% for the FTSE, through to a quite surreal 77 for the Kospi. Interestingly, I did this on Thursday before I sent it to Edison. That number's now 86. Things are moving fast in Korea right now. It's a retail frenzy. We'll come on to that as well. The $100 trillion question, why is it 100 trillion? Because that is, broadly speaking, the global developed market cap. What happens next? First thing is, we don't know. You guys probably don't know either. Nobody knows. We'll see. But here are some suggestions. This, I think, is a very important chart. It's about a month old, but if we redid it, the blue bars would, I'm sure, be much higher. The US public is not big on this war. Partly because it's very far away, partly because they don't really understand why they're doing it in the first place, and mainly because it's costing them quite a lot of money. And although I said earlier that consumers have been recovering, they haven't completely recovered, and certainly at the lower and middle end of things, things are quite tight. And so the idea that their gas is costing them $4.50 a gallon is not going down well at all. Why does that matter? As everyone knows, the midterms are in November. The campaigning usually starts about 3 months before. So we are literally 2 months away from campaigning for midterm elections, and we're fighting a crazy war miles away that nobody understands and nobody wants. So that, I think, is a very important slide, and it suggests that this will end. And we can argue about how it ends, what happens next, the manner of withdrawal, where it leaves the oil price, etc. But our suspicion is that Trump is going to disappear in the next month or two. And we're not putting a huge amount of money on that yet because it's unclear, but that's our suspicion. If that happens, well, essentially we have a binary outcome for global markets now. You have a de-escalation scenario on the left, which is the type of things that will do well if this all goes away. I'd probably remove US equities from that list, actually, because they've already done quite well as a function of being a safe haven or perceived safe haven. But certainly emerging markets, the dollar will do badly, gold will do well, European equities will do well, oil will obviously do badly, etc. On the right-hand side, if we're completely wrong and he decides it's a good idea to go into the midterms fighting a crazy war in the background that nobody understands or wants, then obviously all the reverse things will do well. So if you're an investor, global investor like us, or for that matter, an individual retail investor, this is kind of the most important slide. We go one way or the other. And if we go the way on the left, all the things that did well in January and February will carry on doing well. In fact, some of them already have begun to start doing that. And if we go down the scenario on the right, then all the things that have done well in March and April, particularly oil, defense, and so on, will probably continue to behave. So those are the possibilities. Let's go back again. We'll see. As far as our own positioning is concerned, we have kind of a foot in both camps. We have certainly some things that will do well in both scenarios, and we're kind of waiting until things are more obvious before we commit too much capital either way, despite our hunch that things will be okay. I was asked to focus on one of our thematics, just to give a sense of kind of something we have very high conviction in. So this is it. First of all, it's not gold. We've liked gold for a long time. It did well. It got a bit overheated. Then it got a bit panicky. Now it's kind of in the middle. But it's not about gold. On the right-hand side, the point is just that there is no strong indicator to sell gold now, despite what it's done. The actual theme is gold mining M&A. One way or another, I've ended up, over the last 15 years, probably having 300 meetings with gold companies of one size or another. And what has become clear is that the whole sector is enjoying an extraordinary period of profitability and cash flow, most importantly. They are in record balance sheet health. Virtually all the gold miners have net cash, which has never happened before. On top of that, they're generating record free cash flow because they have record margins. Since I did this slide, that 2,000 number has gone to closer to 3,000, so that's how fast things are changing. The largest gold companies are growing the slowest for various historic reasons, but the smallest gold companies and the intermediates are growing the fastest. The largest gold companies have much higher multiples. When I say high, everything's relative. An expensive gold miner trades on 15 times earnings, which when you look at some of the multiples in tech is obviously still pretty reasonable. But some of the smallest have 4, 5, 6, 7 times P ratios alongside galloping growth, record free cash flow, buybacks, you name it. So if I were the CEO of a big mining company, I know a few of them personally, but if I were one of them, I would be strongly looking to achieve more growth by buying some of my smaller peers. Here is the margin picture. Producer cash flow margin, the blue line. Like I said, this is a few months out of date, but it would now be closer to 3,000, so we'd have to add a whole bunch of bars on the top. Despite the blue, which as you can see is clearly in record territory by some margin, the yellow, which is gold equities, which have gone up and then down a bit since then, so probably not much change, are still below where they were in 2020, which conceptually doesn't really make any sense at all. The whole industry is in a strange place where people basically don't really believe the profitability because of all the bad things that happened in gold mining 10, 15 years ago. The key thing for us with this whole thematic is free cash flow. Somebody taught me a long time ago when I did my evening Masters in Finance all about the wonders of free cash flow. These are the free cash flow yields for this year. If anything, they're probably on the low side because analyst estimates are kind of behind the curve. But amongst the very large companies, we have 8 for Barrick, who reported yesterday, 20 for B2 Gold, which has a slight African element, which people worry about. The intermediate producers, you can see there's some crazy high numbers, 15 to 20%. And the developers obviously do not have free cash flow, but they do have, in those 4 cases, some very interesting assets, which we think will end up being acquired. The long story short is that the average free cash flow yield of a senior gold miner is 5%, and the average free cash flow yield of a junior miner is 7% at the moment. So these numbers are completely off the clock and suggest that probably some or all of these companies are going to be acquired. Full disclosure, do we own them? We own most of those, not all. So that's our highest conviction theme at the moment, gold mining M&A. There's been already 7 large deals this year. Total activity this year, if you include all corporate finance in the gold mining sector, is up 50% year on year. Last year was not a bad year either. This is not going away, and the nice thing is, going back to the previous slides, it is kind of war independent. One thing that we've learned over the years, going back to biblical times, is that mines tend to keep on producing whatever. Centamin had a mine called Sakari in Egypt. When there was the Arab Spring a while back, everyone panicked that it was going to stop working, and so the stock collapsed. We actually bought it back then, and it ended up getting acquired. So gold miners have a funny habit of just carrying on a bit like cockroaches. Whatever the weather, they keep going. So that's that. Now, last thing, because I think I've only got 20 minutes and I'm probably nearly there. The bottom chart was created actually by a fellow at Bloomberg who used to be my business colleague. City's a small place. And actually already it is slightly out of date. I don't know if everyone can see it, but it's essentially the 4 biggest hyperscalers and their capex spend. It goes up to 600 billion. This was done at least 6 months ago, but that number is now 720 for this year. For me, this is probably the most important slide of all. My son's studying economics at the moment and just beginning, and he asked me about this, and I said, look, these are the 4 taps which are full on and putting water into the bath. And what is in the bath is all the people who benefit in various different ways, first, second, third derivative, from hyperscalers spending essentially all their money on capex. So as long as the taps stay full on, that's fine. But as you can see, the growth rate has gone exponential in the last couple of years. And unfortunately, got to pick my words carefully here, unfortunately, that is unsustainable. The growth rate is unsustainable. It's not to say the absolute number will not keep on going up, but it can't keep on going up at the same speed as it is at the moment. And there's 2 reasons for that. One is that the 4 companies in question are growing their revenues only in the teens. They're growing their capex at 100% in the last couple of years, but their revenues are only growing 15, 18, 20%. So if you carry on doubling your capex, but your revenues keep on growing at 15 to 20%, then obviously your capex to sales will blow out to completely extraordinary / impossible levels. So if I told you, I think there are some corporates in the room who probably do their own capex. If I told you that Meta has a 54% capex to sales ratio, 54%, and that has gone up from 42 or 41 last year. Clearly, from 54% of capex to sales, you cannot keep on growing your capex at 100% unless your business is suddenly going to start growing at 100%, which, by the way, it's not. So they're all in the same problem, which is that they have already clearly overdone it. There is a capex orgy of epic historic proportions. It can't carry on at this speed. It will carry on, but the growth rate will slow. And there's an awful lot of other companies whose growth is completely dependent on this chart essentially growing at the same speed. When it becomes clear that's not possible and it's not going to happen, things will probably get quite messy. One other final thing, why would, say, Microsoft, who's one of those bars, why would they think, perhaps they're the orange bar at the bottom, why would they think maybe they were doing too much capex? Well, maybe their shareholders will tell them, because the Microsoft share price is down, I think last time I looked, 18% year to date. It's 22% off the high. Are shareholders enjoying this excessive capex and rewarding Microsoft share price accordingly? No, they're basically saying, we don't like this, we're not convinced it's a good idea. The same thing's happening with Meta. Zuckerberg is saying, don't worry guys, trust me, it's all fine, we're just going to spend, the money will come later, the ROI. But actually, if you think about Meta, they changed their name to Meta. But why did they do that? Because they were going to have the metaverse, and we were all going to be running around the metaverse, having shops and going to the playground and whatever. Has anybody in this room ever done that? Anyone? No? Nobody's been on the metaverse. Okay. So they changed their name to the metaverse because that was the big thing. Nobody in this room has ever been on the metaverse. It was a complete disaster. So they're now saying the same thing about AI. Don't worry, guys, trust us. It'll be fine. We're doing various exciting projects. And by the way, what are they doing? It's very unclear. So it hasn't worked for them. Their share price is going down. Shareholders are saying, what are you doing? So don't underestimate the power of shareholders to say this is just crazy, it's got to stop. I mentioned Meta being 54% capex to sales, but the others are not much better. They're all in the 30s and 40s. That just can't continue. So it's very exciting. Korea goes up 10% a week. All my millennial friends and some of the ones I work with are busy buying call options in AMD and Intel and God knows what else, and they all go up 10% a week, so that's fine. But just please bear in mind that when the capex orgy starts winding down, it will have major implications, not just for the AI companies themselves, but also for the US market, because as per the previous slide, a lot of these companies are very, very big. US is 72% of global equities. A third of that is tech. So it's important. Everyone who's in tracker funds may or may not be aware that 72% of it is in the US and a third of that is in tech, and that it's all kind of doing what it's doing because of that slide. That, I think, is it. Thank you very much.
Absolutely. Thanks, Fraser. Thanks, Toby. What incredible acts to follow. Ladies and gentlemen, my name is Neil Shah. It's lovely to meet you. I head up the technology sector at the London Stock Exchange. I've been there for about 6 years. I'm sure many of you are probably wondering what actually goes on at the London Stock Exchange. I was thinking the same thing when I joined 6 years ago after about 15 years in investment banking. So I sit in a group of about 100 people spread around the globe called Primary Markets. And our role is to help bring some of the most exciting companies onto our markets and to help those companies on our markets, like Molten, like Seraphim, to go harder and faster and to continue to grow. So what I've got here is a few slides just setting out what we're up to the Stock Exchange. So this is my day job, is helping people like Eben Upton, founder and CEO of Raspberry Pi, realize the art of the possible on the London Stock Exchange. Do we have any Raspberry Pi shareholders here? Well done. Yeah, and we've got 2 hands. You're up about 100% following the 24 IPO, and long may that continue. So IPOs get all the attention, but actually they probably make up less than 25% of the capital raised on London Stock Exchange. It's a poor indicator of what's actually happening. What keeps us busy are the companies on the stock exchange that are coming back, raising growth capital. And what we've been doing is trying to remove some of the friction to make it even easier for companies to run harder and faster. The market's always been open. If you look back over the last 26 years, there's been rarely a time where doors have been shut. COVID was a fantastic example of that. 50 billion raised in 2020, 50 billion raised in 21. But markets are there to serve a purpose. It's very easy to raise capital. We saw Rosebank do that earlier this year when they raised 1.9 billion to go and fund 2 acquisitions in the US, thanks to many of you who are investors in some of these companies. And 2026, despite the conflict, has been no different. Yes, I'd like to see a few more IPOs. There's a few on hold. I think one generated 25% of its business in Dubai, so you can see why that's on hold. We've had the SaaS apocalypse, which has meant that software multiples have come off a little bit. And if you're a PE owner of a large software business, you might choose to wait until a slightly better time. But aside from IPOs, we've had a number of introductions. This is companies joining our market that don't raise capital on that first day. We've had transfers from Aquis, like SmarterWeb. We've had companies like Vulcan 2, a fantastic roll-up in the pharmacy space, tapping the market. And there's strong demand. If you look at United Utilities, they raised 800 million recently. I think 50% of the orders when allocated. That book was done in about 20 minutes. That's a strong indication of the level of demand. Seraphim last week, I think, raised about £45 million from retail investors to go and invest in space assets. You've got IQE, which has received strategic investment in South Wales. So there's been a little bit of activity on the stock market, and I see the same in private markets as well. So London, in terms of its standing, still one of the largest stock exchanges in the world. You can cut this chart any way you like. Year to date, last 3 years, last 5 years, last 10 or 20 years. It's a very similar picture. But what we're trying to do is help get more companies onto the market and help us to retain more companies on this market. What's been happening behind the scenes? A lot of rule changes. A lot of supply-side reforms. So this all started with the Lord Hill Review in 2020. We've had the secondary capital raising review. We've had corporate governance being looked at. We've made it easier for people to get paid in the city and on boards. We've introduced a brand new private securities market, and we'll talk about that in a second. And perhaps most importantly, we're starting to see some demand-side reforms as well. We had the voluntary Mansion House Compact, followed by the Accords, followed by the Sterling 20. We've got things like the Business Growth Partnership as well. And I'm pleased to say that the money is starting to flow. And there's no silver bullets here, ladies and gents. It's a combination of all these things that are going to improve the market. So what does this mean for some of the founders that I speak to? Well, the first point is, it's never been easier to IPO in London. And these are not my words. They're actually from JP Morgan, Goldman Sachs, most law firms who, when they're comparing different stock exchanges around the world, recognize that London is now perhaps one of the most founder-friendly venues there are out there. Once you're on the market, historically, would see companies getting acquired way too soon. But now you can raise 75% of your issued share capital without a prospectus. You can raise more than £8 million from retail. That's a huge incentive for the Rosebanks of the world, for the Vulcan 2s to go and do M&A and be hunters rather than the prey. It's much easier to raise retail capital. Pensions is coming too. Pay is important. When Raspberry Pi did their IPO, they were sat across Microsoft and Broadcom in the Cambridge Science Park, and being able to pay engineers and compete was really important, and the ability to pay those engineers is important. The ability for us to hire the best talent in this country and keep them here is important. So I'm pleased to see that investors have really embraced paying execs in line with their global peers, providing they perform, of course. The market's offering more flexibility than ever before, and then we've got PISCES, so I'll come on to what that means in a second. I think the problem statement is really well understood now. We spent a lot of time highlighting this chart. Has anyone not seen this chart before? So just to summarize very quickly, we are underinvesting as a country in the UK. If you look at Australia, about 38% of their local pension funds are invested in the stock market. In the UK, we're at 3%. I hear from some pension funds that there's not enough companies, not enough good companies to invest in the UK, and I say to them, you're not looking hard enough, because I'm tracking about 900 companies, many of which will hopefully IPO and use our markets. And the good news is that we're making progress in unlocking some of these funds. Some of you were kind enough to sign a letter from my group CEO, David Schwimmer, to the Chancellor last October. We had about 300 signatures from businesses, public and private, asking that in order to qualify as a default defined contribution scheme in the UK, you've got to actually allocate to the UK. You can offer employees one or the other. We've had the Mansion House Accords, and some of the things I spoke about, we're starting to see local authority government pension schemes being consolidated into mega funds. Borders of the Coast is a good example. The Business Growth Partnership as well, where you've got M&G, Cushion, and one other, investing in companies like Wave and Kraken, and hopefully into public markets soon too. And then you've got a retail campaign to get retail investors investing, because as Toby said, if you're just relying on your S&P tracker, God help you. Hopefully there's going to be some interesting companies, interesting IPOs that you can back here, and it's great to have broad-based support for what was supposed to be Tell Sid 2.0. So this is the Savvy Squirrel campaign. Not a name I came up with, but it's got broad industry buy-in. I would say about 90% of my job is raising awareness and myth busting. I meet so many CEOs with $30, $40, $50 million of revenue who love the US markets and think they can IPO there. And my job, the city's job, is often just to convince them, actually, you're probably better off starting here. And here's some of the reasons why. We saw on the last chart how some of these companies have grown. NVIDIA at $5 trillion. When Meta prices its IPO, when when SpaceX comes to IPO and looks to raise about $75 billion, that's almost 2 times as much capital that was raised in the US stock market last year outside the SPACs, about $44 billion. It will be an enormous deal, but also that's where all the attention is going to go. SpaceX, Databricks, OpenAI, Anthropic. If you're an average unicorn or a decacorn, this is the play for London. I think we can help these companies to get proper investor attention here. So we often say to companies, you probably need about $10 billion of market cap to get noticed in the States, about $500 million of revenue. In London, we've had fantastic stories. You look at Craneware, that started with about $50 million. You look at Cerillion, look at Boku, about $20 million of revenue. Paphos Communications that IPO'd from Dubai in December, $13 million of revenue. We have a market that can support these younger companies to grow. And also, I think we're not obsessed with 50, 100% growers. The good news is that some of the companies I'm tracking are growing at that level, and hopefully we can bring some of those companies to London. But I think there's a huge opportunity for us here in the UK. And you know what? To get onto a market, you don't even need to use the SPAC. You can use our front door. It's wide open. You can IPO in 10 or so weeks. And this is our mission. It's basically to help companies start or land here if they're international, to grow, scale, and most importantly, to stay. And that's why unlocking domestic capital is so important. And we're the first stock exchange group that's truly agnostic between public and private markets. When we presented PISCES, we had a lot of questions, particularly from the Nomad community, to say, what's going to happen to AIM? Some of the companies that are using PISCES, we've had our first trade in March, weren't interested in the stock market. And this is our way to potentially get them onto the main market in the future. We are talking to some really exciting companies. You're going to see some trades pre-summer, hopefully, that will show you what the art of the possible is. Is everyone familiar with PISCES? Okay, let me just take a step back. So about 3 years ago, the Treasurer and the FCA came to us and said, is there a need for a market that offers periodic liquidity to companies worth less than £50 million of enterprise value? And we said, brilliant idea, but you're focused on the wrong prize here. The target ought to be all companies. There's a number of companies that have been staying private for longer, where you've got employees that have taken a below-market salary that haven't been able to realize liquidity, but we know that company is going to be worth a lot of money if and when it IPOs, and it would be a tremendous loss to the UK if we saw these companies continue to get acquired or to go and IPO elsewhere. So what if we could help them by offering periodic liquidity in the UK, by allowing a company to run an annual employee share sale, to do that potentially quarterly if they so wished. So we got authorized in August last year. We had our first trade, which was Oxford Science Enterprises, coming to market through TPE, and we've got a couple of really exciting companies that will be using this market pre-summer, and a whole backlog of second, third, and fourth movers that will use this market. And they might be at what venture capitalists call Series B, Series C, where they've raised a little bit of venture. There might be friends and family, angels, employees who need some liquidity, and on the other side, high net worths, family offices, pension funds looking to invest. And this is potentially open to some of you as well. We've signed up about 20 or so banks on this platform, and I'll show you what that means. And think of this as an elevator that runs alongside our public markets. Yes, of course, you can IPO early, like Paphos did with $30 million of revenue. But if you want to use venture, hopefully you can use the private securities market, and at some point join us on the main market. So early investors, liquidity for employees, it's a means to clean up cap tables, to remove the overhang before an IPO, the ability for founders to pay back friends and family that might have supported them at the early stages, and a stepping stone to IPO. And most importantly, it's open to international companies and international investors, where we've had a lot of inbound interest. So this was that trade for Oxford Science Enterprises, and we spent the last 6 or so months signing up many of the banks and the investment platforms you see on the bottom right here. So a lot of the mid-market banks are on this platform. You've got platforms like Crowdcube, who have about 2 million retail investors, about 250,000 high net worths who can participate in some of these transactions. So hugely exciting time. Every founder I speak to wants to hear about PISCES and the private securities market, potentially as a stepping stone to public markets. So we're going to see a lot of action there. And we're hugely committed to the city. You might see these plans at the City of London's website. We're going to be refurbishing the stock exchange. We've been there for about 20 years, since 2004. And what we want to do is highlight what happens in our world outside. You're going to see us emerging around train stations in the UK, promoting some of the companies on the market, but also some of the new companies that are coming to the market. And if you haven't been to the stock exchange, we'd love to have you come and see us. That's what I had to say. Thank you.
Excellent, thank you. We've now got an opportunity to break and grab a coffee before the first panel starts. Yes, I think there's very interesting conversations. If you want to chat to either of the presenters on the keynotes, please do just come and say hello. I'd like to just acknowledge as well, as at Edison, we're very much sort of champions of the investment community. We're champions of the secondary market. And we're big supporters of everything that the London Stock Exchange is doing. You know, we think it's very, very important that the UK has a very powerful capital market, and it does then filter out into all sorts of other areas of industry and economic wealth. So I think it's great what you're doing in the private space. But anyway, so thank you for the speakers. If you would like to break for a coffee, oh no, sorry, I'm getting a quick signal that there's no coffee. Oh, it's after the panel. Okay. So, am I going to talk for 10 minutes, or are we going to bring the panels forward? I think that's probably better, isn't it? So, well, listen, that's great. So we'll have a longer coffee break a little later. So please do, during the panel, if we've got a bit of time, do ask questions. Do, you know, the purpose is that everybody's here to present to you and to give you that opportunity to listen and to learn. So our head of technology research and a fellow board member, Dan Ridsdale, is hosting the panel. Dan, I will step aside and let you take it from here. Thank you.